Hello traders, welcome back to Golgifx, and this is your boy Golgi. So in this video, we'll be looking at the most volatile currency pairs and how to trade them. So if you are new to our channel, please like this video and subscribe to our channel to be notified on the coming videos. Traders, let's get into the video. So before we start, I want us to look at these two important terminologies in trading, which is volatility and liquidity. So let's look at the meaning of volatility. So volatility in finance means the frequency and the strength of price change. So anytime we are looking at an asset and they say that an asset has high volatility, meaning its price fluctuates a lot within a given period of time. So anytime you hear someone saying there's volatility in price or there's volatility in this pair, meaning then the person is talking about the frequency and the strength of that price change. And when he's talking about high volatility, meaning he's talking about high price fluctuation within a given period of time. So let's look at the next one, which is liquidity. So liquidity is the amount of supply and demand in the market. So if there is larger supply and demand in the market, then the harder it is to get a price moving. So these are two important terminologies in the financial market that you have to take note when you are trading. So if you want to understand the currency pairs, you have to understand these two terms, which is volatility and liquidity. So now let's move to the topic of the day, which is what are the most volatile currency pairs. So they are the emerging market currency pairs. So these pairs can clock some of the highest volatility reading, and they are the most volatile currency instrument. So these currency pairs include one or two currencies of the emerging market, and they can also be called the exotic pairs. So let's look at some of the examples of these exotic pairs. So we have the USD, the USD Tri, and the USD MXN. So these are some of the emerging market currency pairs, and these are highly volatile. So they are characterized by low trading volumes, and they are extremely risky to trade due to their high volatility. So one reason why they are highly volatility is that they have fewer market participants for the buying and selling, and also it is much easier for buyers and sellers to push this quote up and down, so which makes this pairs very volatile. Also, we have other volatile currency pairs which are from the majors. So some of them are the AUJPY, the CAD-JPY, the NZD-JPY, the AUD-GBP, and the AUD-USD. So these are also some of the highly volatile pairs which are from the major currencies. We also have currencies which are more liquid and less volatile. So these currencies are the ones which attract more trading volume and facilitate greater price stability in turn. So we have a classic rule that states that the higher the liquidity, the lower the volatility, and vice versa. So these are some of the examples of the major currencies which are more liquid and less volatile. So we have the Euro USD, the USD JPY, the GBP USD, and the USD SHIB. So these currencies are mostly traded and they are more liquid, but they are less volatile. So now, if a trader wants to trade currencies which are highly volatile or currencies which are more liquid, how will this trader go by it? So let's see how this trader can trade. One of the things that the trader can see is, the first one is currencies with high volatility will normally move more pips than currencies with slow volatility, and this leads to increased risk when trading currency with high volatility. So if a trader wants to trade currencies with high volatility, you have to note that these currencies move a lot and they have more pips that gives when the trader is trading. So it gives you more pip, meaning when you are risking more and the market is also pushing against your direction, it makes it you are losing more in pips and in currency. So as a trader, you have to take note of this. So one thing that you also have to know, since the high volatility currency pair makes bigger moves, you should determine the correct position size to take when trading. So when trading these high volatility pairs, you always have to manage your risk. And also the second one that we are also talking about is your position size. You don't have to open bigger position size. You have to be able to understand your risk and calculate it, and also understand these pairs are highly volatile, so they move faster. So traders, these are some of the things that you have to take note when trading these currency pairs. You have to know and also understand these two different currency pairs, the ones which are more volatile and the ones which are more liquid, and be able to look at your risk management and your positioning size and your trading strategy and go with it. So traders, that's all for this video. I hope you like it. Please like and subscribe to our channel, and see you in the next video.